Welcome back to another episode of Gimme Some Truth. The originals in the booth today.
That's right. Oh, geez.
It's not often that we do. We have a big staff now. We have to get everybody involved, so it's not often we do. But today is alternatives, which is interesting because what it meant, even 5-10 years ago for most investors, it means something different today than it did before.
It does. We have the most access that we've ever had before in our careers. It used to be, now everybody had to be a qualified purchaser or a qualified investor, to be able to do these sorts of things. And
for a second, what is that?
Okay, so accredited investor is like $1 million or more in net worth.
Yep.
And then qualified purchaser is like $5 million of investable assets, not net worth. So, and those are benchmarks set up by regulatory agencies saying, okay, you have to be these sorts of levels to be able to even have access to these investments. And that still exists for a lot of these investments, some of the ones we'll talk about today, but a lot of them don't require that anymore, and they're moving to different sort of fund structures. So what we saw is, you had to do all these private placements, and you had to fill out all these subscription documents, and you still do for some of them, but others now are doing an interval fund structure. So it's kind of like a quasi-mutual fund that has some liquidity provisions. And all you have to know as an investor here is that, you can get access to some of this stuff through your custodian without having to sign all kinds of subscription documents in some cases. So because those have started to become more front and center, we've been talking more and more about alternatives because the access is greater, and also just a situation where I think it's showing up more in the news, and people are looking outside of stocks and bonds, particularly when we see valuations a little stretched right now, and they say, what else is out there?
Yeah, I think that the reason why this is happening for the most part is because a lot of the investment world has been offering these types of investments to the ultra high net worth for a long, long time. So these aren't new ideas. The new piece of it is, can the more kind of millionaire next door, maybe $1 million to $5 million, $1 million to $10 million of net worth client can get access to these in a way that is relatively easy now, where for a long time, these were, for the most part, people that had 10 million of net worth and above.
That's right. Yeah, and there's a lot of diligence that are required of these investments because a lot of them are fairly illiquid. So you've got to be careful. These are not risk-free investments by any stretch of the imagination. A lot of them do carry high fees. So there's no wonder that, post this sort of index fund renaissance that we've all had, that all of these giant providers now are coming in to provide access to the general public. They are mostly higher fee. They are mostly, fairly high compensation, I have to assume, in most circumstances, to the providers. We're fee only, so we don't receive any of that compensation, but there's definitely embedded compensation to a lot of the intermediaries in there. So you have to tread lightly. And that's why we always say, if you're going into this isn't like I'm going to dabble a little bit. You need to have a professional kind of do the due diligence for you and make sure that they're looking what's under the hood.
Yeah. And also you're not moving 50% of your assets into something like this. This is a small portion of your portfolio, really designed to try to provide a little bit of differentiation from the standard equity, fixed income. So a lot of the stocks are kind of, for the most part, built in a similar fashion for portfolio bonds similarly as well. This is a different animal. This is definitely a different asset class, at least the ones we have today. So let's jump into it. Private equity. When we say private equity, what do we mean?
Well, we mean the sexiest form of alternative investment. Private
in your opinion.
I mean, yeah. Why not? There's all kinds of different ways you can get PE, but I mean, if you're in the PE world, you're feeling pretty good about yourself.
We haven't gotten to private debt yet.
So fixed income is so boring. Anyway, but the fixed income, you talk to a bond guy, I mean, you will go to sleep. But private equity, though, on the other hand, just investing in companies that are not yet public is definitely a definition of that. And so, there's a lot of private companies here. We're a private company.
Right.
We actually have private equity approach us sometimes to say, hey, we want to buy into Walkner Condon. And so there's funds that are available for this purpose. And the funds are set up in a bunch of different ways as far as where they're investing in the capital spectrum. So you're saying, okay, I might be an early stage company. And if I'm a super early stage company and I'm just kind of in that incubator stage, then venture capital might be looking at us, where we got an idea, it's proof of concept, there's not much revenue there, and you're buying in at literally one of the earliest stages. So somebody's kind of buying that brain of that founder or founder group, and they're going and trying to make that super parabolic rate of return.
Really, all you're buying is potential future growth.
Yeah, and that's like the riskiest of risky
growth.
because
Yes, right.
you're going to strike out on a bunch of those. You're going to think, oh, this idea is great, and it's going to flame out. And, if you hit 1 out of 10 in those, you're probably doing fairly well. That's just an estimation. But,
Right.
The VC world is there's less funds inside of there from those big guys.
Right.
The big guys are really looking at, secondary market or later stage private equity, just meaning that they may have raised money a number of different times and they get an entry point later. So you'll see in there, oh, we raised our Series D. And that means that usually it starts, kind of venture capital, and then it'll go through like A round, B round, C round, D round, and just, some are on F and G and H round of funding. So it just means that there's more and more funding each way. And hopefully what happens is they're raising at a higher rate of capitalization each raise. So, you're hoping that goes in and you're entering at a certain point.
Yeah. So, I mean, simply put, the later you are in a stage of a company raising money, you have more data about that company. You have more information in terms of whether this concept is actually viable. And you probably have a pretty good understanding at that point of whether or not this company has the makeup to make it, right? Does it have the management group it needs? Does it have the product does it need? Does it have the patents in place? Does it have everything it needs to get there? And so therefore, later stage, your potential for kind of home run or grand slam growth, maybe not as much as in the early stages, but still could be a viable investment for somebody that is looking for that option.
That's right. And then what you're hoping is at some point they go IPO and they go public and then you're kind of able to exit that way. Or there are other ways where, private transactions, you can always kind of move the private stock. If you have an offering and somebody, buys that from you, there's a private market out there. It's just a lot less transparent. It's a public market that gets valued literally every second.
Right. But in a lot of, in every equity purchase, you are a part owner of this company if you invest in it. And so therefore you have the characteristics of, a stock holder. If we move on to private debt, that's a different world. That feels more like the bond side of a typical investment, but definitely has some differences.
Yeah, and so what most people used to do with lending is they go out and just get a loan from a bank. But now with all of the capital that's out there, there's a lot of alternative financing options where they might not want to go to a bank for a variety of different reasons. It could be rate, it could be credit requirements, it could be a number of different things. Maybe you're not a traditional company. So this private market exists. So, one example of that I ran across as a potential investment was there was actually a bunch of different cannabis businesses and they needed funding and they couldn't go to a traditional bank. So there was a private lender out there providing this sort of loan and you could own in a fund and own this private debt. And so obviously it paid a really high yield because there's a lot of risk in that industry. So that's just one example of an area that you can buy. And there's also very traditional stuff too that's out there. If you were in a situation where, you needed to do a refinance of receivables or, something like that, you could go and invest in these private debt funds. And there's all kinds of different debt out there. It could be in companies. It could be in real estate, although that's its own subsector. And then there's all these different offerings. If you wanted to expand here at Walkner Condon, we could go get a loan from another spot and somebody could buy that paper and hold it. And what you're really trying to achieve there, they do their underwriting and diligence just like everybody else does. But oftentimes you're getting a higher yield than if you just had like a treasury note or bought a very traditional corporate bond. So you're usually having a above market yield in there. It is a more high yield investment. Does carry more risk there because it could be a bit more concentrated or they can be large funds as well. So you can buy into some of these, like Blackstone's a huge one, and they've got all these different private debt funds that are gigantic funds. And Cliffwater's another example of that. They've got a variety in a portfolio of a whole bunch of different private loans inside of there, trying to achieve a yield that's higher than the standard market.
Yeah, I think the key differentiation there is, as opposed to private equity, what is your rate of return? You really have no idea, because it could be negative down to zero. You could lose all of your money. You could, double your money, triple it, 10x. Private debt different, because you're getting a yield. You know what your return is going to be, because this is the interest rate that they're paying on that debt. You don't have any rights to the growth of the company or the kind of expansion. In that way, you're simply, as we say in the investment, we're clipping the coupon right off of that bond, or collecting the interest, and that's what you're going to get. So it might be a very attractive interest rate, it might be 8, 9, 10%, but that is what you're going to get in terms of the best case scenario, right? Worst case scenario is obviously you could lose some of your principal, that kind of thing, but you're not going to make more than that, because you are simply providing the funding for them. You are not participating in an ownership position.
Yeah, unless they default, and that could be the collateral. But if you receive the collateral, it's likely at a huge discount, right? You're probably not making money from that. So, you're in bad shape if you have a default situation. It depends where you are in the capital structure there. So, if you're first lien position, one thing too that can work for you or against you, a lot of the private debt offerings have a lot of floating rate loans. So if interest rates climb over time, that'll benefit you. But if they go down over time, that could be negative as well. So a lot of that paper is shorter term paper than, say, a corporate bond that could be locked into a 10-year rate of return. So a lot of these things are shorter term financing events as well. So
that's the nuance too of understanding what you're buying, right?
Exactly.
Are you getting a fixed? If you are getting fixed, for what period of time is that fixed? Is there the ability to call that loan? Is there the ability to refinance? Is there the ability to take on more lending, potentially hurting your capital or your position? So again, those nuances are what's really important about these investments, is understanding where you sit. Everybody would love to look at it and say, great, give me a fixed 9% rate of return. I love that, of course, but that doesn't come without some pretty important distinctions that you need to be aware of.
And the funds can gatekeep their situation as well. So if you start to see a bunch of defaults and you said, I want to redeem my funds, they could say no. Oftentimes they only do, say, 5% of the outstanding shares available, or they could stop it at any time as well. So unlike,
you could get trapped.
So unlike an ETF where you just hit a button and sell it, this isn't really like that at all. So you've got to be careful about what you're investing in there, and you don't overcommit to these.
Yeah, and I think we want to be clear about this. We're not trying to scare people in terms of a lot of negatives and no positives. It's just realizing that this is a different kind of investing, and it's not inherently good. It's not inherently bad. It's just a different style of investing, and you can understand through this conversation to this point why there are regulations to not allow any investor in a lot of these cases to be able to invest. They want to make sure that these are experienced investors that have a good amount of assets behind them, so that they're not putting their last dollar into these types of investments. Mm-hmm. So let's move on to real estate in the same kind of equity debt structure. This is different because you are in many cases buying into an actual building or development or expansion. It's not as though you're buying shares of a company necessarily, right? I think that's probably a clear way to kind of draw a line between the two.
Yeah, you can get some diversified ones, but oftentimes what we see is somebody comes to us with a local provider, and they're doing a building, and they're doing an offering, and it could be an equity offering, it could be a debt offering, and they'll go up and they'll say, hey, we've got a group of buildings, or we got this building, and we're going to, raise money for this project. And they try to raise the majority of money and then piggyback a loan on top of it. And then you're an investor in that project, and the project lasts X amount of time, and they try to get a rent cycle or two, and then they, may flip the project and try to sell it. And so it could be as non-diversified as one project. It could be as diversified as an entire group. One offering that we have looked at in the past, where you're more of an equity owner, is student housing.
Yep.
kind of an intriguing sort of investment where they raise money, they build the student housing out there, they try to go through one rent cycle, and then they sell the building to a pension or an endowment or another real estate investment trust fund,
Yep.
and then they exit that way. So really they're trying to develop. So it's got a little concept of that sort of venture capital, private equity inside of this real estate thing. And, they've had a track record that's been a good track record. So, we can kind of rely on that past track record of doing these student housing projects. And so that's how a lot of those happen, and they try to get a good solid yield. And once the projects gets finished and they get the liquidity event, then they'll send you your principal plus the interest back. And so you kind of get your money over time.
Yeah. So that example it wouldn't be dorms. It would be apartment buildings that are very close to campus and cater very much towards students. And so that's a good example, an apartment building, a 6, 8, 10-story apartment building that might have 50 to 100 units in it. That costs, $20, $30, $40, $50 million to build it, depending on how they're going to build it. You might be into that building only, right? Mm-hmm. Or you might be into a 4 building apartment development where there's going to be 4 apartment buildings, all have 40 units each. You might be buying into that project. So again, it's a way for the developer to be able to raise money outside of just your traditional bank lending or in conjunction with bank financing. And then in most cases, as we said on the equity side, you kind of receive your payday, if you will, when they sell the building in most cases.
Yeah, if you think about some of these big developers, I've seen a land fund then that goes, they want to develop to a point where they're getting all the contracts, they're developing the subdivision, they're getting the lot plots, all of that, and then they get a builder, and then they either go all the way through that project or they get it up to handing it off to a builder, and then they're kind of washing their hands of it. And the reason why they raise money is they can't just go get a loan for this, and it costs a ton of money to get started on it. So they'll raise the money up front and they'll offer either debt or equity on this project and then the exit. So yeah, there's companies that'll do any sort of any of those through the process all the way up to they develop and go all the way to the end. That could be like an 8-year investment cycle, or they can have one that's shorter, that's 3 or 4 years to get you to a certain point and then they exit. So a lot of different funds in this and a lot of different players, but private real estate is kind of fascinating. And then the debt side of it too, they have kind of similar to the private debt. They've got, say I've got a large apartment building. It's going to take a bunch of money and I need to raise some money there to do my remodeling. So there might be a private debt situation where you put the building up as collateral, you get the remodel done, and then you finish that and then start paying off the note with the increased rents that you have over time without getting a traditional loan.
Yeah, or you can have a big apartment building where you get to choose. Do you want to be on the equity side or do you want to be on the debt side?
Correct.
They're raising money for the building to get it built, but they're offering the ability to say, hey, you can either participate in the upside of the unknown upside of what it might be when we sell the building at the end, not knowing when that's going to happen or how much it would be, or you can be on the debt side, which we're going to pay you a fixed interest rate for a period of time, but you do not get to participate in the upside of the sale. So I get a kind of a little bit more of a kind of boring, if you will, kind of stream of income, or I get this ability to make little or make a lot. So in some buildings, they'll actually offer equity or debt, and as the investor, you get to pick what side you want to be on. So let's keep our producers happy and not go too long here, Mr. Walkner. Let's hit these last 3 relatively quickly.
Yeah.
We can do that.
Let's do it. A little speed round.
Speed round here.
Alt speed round.
Which is great because the viewers don't know what the last 3 are. So this is kind of a traditional speed round. Let's go commodities first.
Okay.
Let's talk quickly about commodities. Commodities is kind of the old school alts, I would call it, right? It's been around for ever and a day.
Yeah, I mean, that you can get more liquid. You can get it through an ETF, so a little bit eeasier way to get exposure from that if you choose, but there's also private investments there. You can do, CTAs, which are, a form of commodity investing. There's also just owning your precious metals. So you could go buy your gold bar at Costco and now you have an alternative and you have it in your house. Like that is owning an alternative investment. So there's a variety of different those. I mean, most people think about, commodities being as wheat, soybeans, kind of your soft commodities, and then you've got your hard commodities, which would be your silver and gold and things like that are a little more traditional. So that's definitely things that we've used in the past with portfolio management for sure.
Definitely hearing more about it because of inflation perking back up in the last couple of years. Commodities had kind of a, I don't know, I guess I'll call it a dead period, if you will, for a long period of time when inflation was non-existent, and so it's kind of giving a little bit of a run now. Crypto.
Yeah, I mean, big alts that people have been inquiring about for sure, and some people have just dabbled. I saw today that Coinbase is getting added to the S&P 500. I mean, who would have thought? So, a situation where crypto is obviously very big, gone through very large upside and downside captures in particular funds. Bitcoin, Ethereum just being your old G's there, and then you've got a whole bunch of different coins now that are out there. We're hearing more about Solana. ETFs are being issued now. So we have an ETF in Bitcoin, we have an ETF now in Ethereum, and it looks like Solana's next. So, and maybe Ripple. So we've got a number of different ways that we can access crypto, and obviously you can buy them through a whole bunch of different brokerage places as well. So they're they've been added to a lot of portfolios in the past, and now we have more access to them in an easier way, rather than just going through your wallet and your storage through an exchange that occasionally, and I have experience on this, occasionally goes bankrupt. So not the best. So I was one of the guys that got my Voyager brokerage house went bankrupt, and so you lost a bunch of your asset value, which kind of sucked. But so they carry obviously a rate of return profile that's a lot more aggressive.
Yep. Let's finish up quickly with hedge funds.
Yeah. So hedge funds are one of the more interesting things that people talk about alternatives, because I constantly see hedge funds compared to the S&P 500 for rates of return, and it couldn't be further from what the actual goal of a hedge fund. If we're looking at true hedge funds, the goal of that is to be really market neutral. So depending on whatever market situation there is, the portfolio is short some securities and long some securities, and it's basically hedged out. So it's basically a net zero. That's the very traditional look at a hedge fund. They come in all kinds of different flavors. But when we're saying that, it's really market neutral. So you're saying in any type of market, I should be able to make money through this sort of structure, and that's what these hedge funds are setting out to do. And they've got a whole bunch of different rate of return. You've got global macro hedge funds, which, you've got event-driven hedge funds. So you have another 2008 event, and you get that big rate of return. So all these hedge funds are kind of set up to do different things. Private, very not very transparent at all.
Right.
A structure that's kind of a go anywhere structure with a lot of these funds. Can carry very little risk or an astronomically high amount of risk, usually very high fees, private sort of funds, the kind of thing that you see when you see some of these, you look at HBO or whatever, or Max as it's called now, and you see, who was that Showtime? The Showtime Billions show was based around, a hedge fund manager. And so those are funds that you can get access to, but generally at a much higher level of minimum. And so those are generally the guys that are driving around the private jets. So, yeah.
I think the takeaway is that if we just think of our investments as equity and bonds or equity and fixed income, we're missing out on a real opportunity to diversify beyond just the traditional ways of investing. The way that Clint and I look at it in our firm is we want investments that will help to buffer a portfolio and provide a little bit different flavor to it, especially with what looks to be on the horizon over the next 10 years in the market. Maybe not as rosy, especially not as rosy for U.S. equities and just your standard S&P 500 investments as the last 10 years was. Hey, what else can we do? We're getting that question more often. We're within our firm ourselves asking that questions of ourselves. What more can we do? What other things can we do? And not get too esoteric, but yet at the same time realize that that there's more than just stocks and fixed income out there. So if you want to talk more about this, we'd love to have a personal conversation with you in terms of how this applies to you and your own investments. So please reach out to us. If you have any comments or questions, please feel free to put those in the comments section as well. And as always, we look forward to seeing you on another episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.